Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, October 27th, 5:30 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida with the Big Show, the Friday edition of the Revere Market Insight video, where we take a look back at the prior week, take a look ahead at what's important to know for next week. And this week, instead of looking at the 21 leaders list, because there really isn't a leaders list going on right now, it's more of a survivors list. But we're going to take a look at 18 earnings, quote unquote, winners. These are stocks that reported this earnings season and had a positive day one reaction. And we'll see the follow up to that positive day one reaction. So, state of the market, we're in a moderate correction. We define corrections as are displayed on this chart right here. We've got right now moderate, meaning 8 to 12% off of the recent highs, or a little over 10%, maybe 10 and a half off the highs right now. Next level down is a harsh correction, which would be 12 to 20%. You can see our expectation of how we should be performing during these types of markets, showing minor outperformance now. That's what we've seen over the last 3 days, about 180 basis point gain versus the S&P, what the S&P 500. We still are on the negative side, but nowhere near as bad as what the market's doing. And this is a function of the studies we've done in the past, healthy markets versus risky markets. If we continue on into harsh correction, our performance will get even stronger relative to what's going on. In fact, we can have positive gains if we get on the right side of some inverse ETFs and sectors that are trending lower. So anyway, the title of this video, this week's video, the theme is the Thank You Sir, May I Have Another edition. And this iconic scene and saying from Animal House, it was a fraternity hazing situation, and the candidate just gets to bend over and get paddled, and after every paddle he gets to say, "Thank you sir, may I have another?" And that's what the market's doing right now. No big capitulation, no big shakeout saying, "Okay, I'm done, enough already," just a continued bleed lower, breaking through support level after support level, and best to be out of the way and lightning. And that's what we've been detailing the last 2 weeks in these videos. See the trend gauge over here, market leaders showing bearish slash downtrend as of last Friday. As of last Wednesday, all 5 of the major indexes have been trending below their short-term 21-day exponential moving average. Bearish versus the 50-day moving average going back to late September. We had the NASDAQ 100 try to get above but couldn't stay above. And then all 5 major indexes against the long-term 200-day moving average. This one is really slow to move over to bearish because we factor in the slopes of the line of the 200-day moving average for the indexes. The 200 and the 150-day are still sloping higher for the second leading index. That's the S&P, which broke through the 200 this week. The NASDAQ 100 still above the 200. But the 100-day on the S&P has now turned lower. The 150-day still trending higher, as well as the 200-day. So that's kind of so you're saying there's a chance from Dumb and Dumber. But anyway, we're not dumb enough to stay fully invested in a risky market. We do know that. So what happened today? Excellent reaction to Amazon's earnings Thursday night, sparked the big seven. But we gapped up, but by the end of the day, the indexes were lower, with the exception of the NASDAQ 100 and the Big Seven. In fact, 4 of the 5 major indexes at their correction lows, the worst being the Russell 2000, which is actually at 3-year lows. So lows below the bear market lows. If you've got any question as to why, we track the RG8. This is primarily small and mid cap growth. We've got some large cap growth indexes mixed in with here, but the genesis of this was 2021, mid-February 2021, when growth stocks started to dive as interest rates had a breakout. It didn't show in the big cap indexes, but it sure did show in growth stocks. That's why we track this every day. So the final numbers, Big Seven up on an average of 1.73%, led by Amazon up 6.8%. 8 growth ETF composite, the RG8, down 1.03%. S&P 500 gapped up 0.4%, ended up down 0.5%, ugly negative reversal. NASDAQ 100 gapped up 0.8, was up over 1%. By the end of the day, that had been whittled down to a 0.5% gain. Nowhere to hide in the Dow, down 1.1%, mid caps down 1.3, Russell 2000 small caps down 1.2. Global diversified 60/40 down 0.14%, buoyed by international bonds, which were positive. In-house GROTECTION down 0.14%. We added some. We'll talk about our changes in the portfolio. We added some things with, but our beta is still lower than it was yesterday because we got stopped on another piece of our SSO position. So let's get to it. Let's start off with the S&P 500 on a daily chart here. You can see quite clearly the break below yesterday's low, this 4,100 area, a next area of support, but certainly a disappointment that we're below 4,200, couldn't hold it. And that 4155, that was a key fib, a 50% retracement of the bear market level. And in fact, unfortunately, on the rally up today, that's where the market stopped going up. So if that level has flipped from support to resistance, all the worse off for the markets. Let's go to the NASDAQ 100 inside day because of the Amazon and Big Seven strength, still above the 200-day moving average there. Dow Jones Industrial Average making new correction lows, as you can see here. Well, correction lows back to March. Correction off of the rally off the lows. Obviously, there's no more rally off the lows with the small cap since they made 3-year lows. Mid cap still not quite as bad, but still making correction, new correction lows, and IWM here. 3-year lows. I'll go to the weekly chart here. Let me actually show it on the index itself here. Our US, you can see going all the way back here to late October, early November, the last time we were at these levels on small caps. Rising interest rates are just kryptonite to growth stocks. VIX up, as you might imagine, with the indexes down, but not making a higher high. So minor positive divergence there with the indexes making lower lows. The dollar, tight ranges lately, still in this handle of this big cup and handle that's being formed, and the normally inverse correlation with precious metals has not been as in effect. As you can see with the stronger dollar, gold broke above the midpoint of this double bottom base. Now we added to our GLD position today. You can see these big blue bars and the relative strength line screaming by me. GDX, not as good as gold. That's typical that stocks lag the commodities. Commodities are kind of people want to own hard assets. It's a fear trade also. We're seeing this with oil being up and oil stocks selling off too, but you can see the GDX still below the 200-day moving average here. Hi-Ho Silver up 1.6% today, still not as strong as gold. Let's go to Bitcoin, which had a big gap up on that supposedly pending, seems like forever now, spot ETF, holding the gap, but 2 straight days pulling back. Let's flip to bonds now. The broad bond index, basically flat. BNDW, the world bond index, up on the day, meaning net on average worldwide yields pulled back slightly, but not on the long end. The TLT price was down, which means if you look at TYX, the 30-year, you're going to see a higher yield. Still not making highs. So dollar and rates did not make highs while indexes made new lows. That's not a good sign. The 10-year still below 5%. That's a pretty big psychological and significant level there. Let's get to the tail of the tape. Not a lot of good to show here. Before the opening, PCE inflation data came out, and versus expectations, spending was higher. Fed didn't want to see that. Inflation basically in line, so nothing to see there. Income lower. The Fed does like that. And when it came out, there was really not a big impact on rates or on the market. It wasn't until after we opened that we attempted to make highs and got reversed pretty quickly, making the day count from down 6 of the last 7 to 7 of the last 8. 8 days below the 80 EMA and the 21 EMA. Third wave down is in progress. Let's go back to the S&P, and I'll show you what I mean by that. Very often you see 3 waves down and moves lower. Here's the first wave, here's the second wave, here's the third wave, and it's been pretty symmetric. We talked in our podcast about how this maybe an area where we see a bounce, and we actually were bouncing when we recorded the podcast around noon today, but ended up breaking lower by the end of the day. Let's compare this to the three waves down that we saw during the bear market of 2022, and you can see the three waves down there, much harsher and on a much more drawn out basis. It's not quite as easy to see here if you look at it on a weekly chart, but these types of things are fractal, and this is a decent, even 4100 it really needs to hold. Not a lot of support lower. Make sure you check out the podcast. Connor talked about a big volume shelf that we were hoping would hold here, where it made sense to. But when things make sense and are supposed to do things and they don't, that means the market's even weaker than it would appear to be. So back to the tail of the tape, the ATR on the S&P continues to go higher. This is in line with what we're seeing on the VIX, now up to 1.35% on a daily basis. That's a negative. As far as sectors go today, XLK and XLY were up. This was mostly Amazon carrying over to the tech sector. Semiconductors up. Oil, the commodity up, but the oil stocks were down. Gold, silver, and gold and silver stocks up. TLT down, dollar down. A lot of defensive sectors down, nowhere to hide today. Energy, financials, staples, utilities, medical, and real estate all lower, and regional banks lower too. So in-house, we added to GLD, as I mentioned. We also bought a PDBC. This is a commodity ETF, oil, gas, base metals, forming a nice consolidation here, and the relative strength is what we're looking for. It broke above this little downtrend line here, and commodities themselves acting well. And this does not have a K1. A K1 is a nasty tax form that you get that may charge you taxes regardless of, it has to do with the underlying trades, and it's passed on to you. Anybody that's ever owned a mutual fund in a taxable account and gotten a capital gains bill, it's kind of similar to that, but this does not have a K1, so we stay away from K1 ETFs for our clients. But we added a PDBC, and then with that failure into the 4155 area, we trimmed more of our SSO position. Also bought a T-bill mutual money market mutual fund short term. So going more to collecting the interest. We've got 50% of the portfolio in yielding higher than 5% now, while reducing our beta from 0.3 to 0.21 and taking on gold and commodity positions. So, but the bottom line, despite the gap up, 4 of the 5 indexes made new correction lows, and the Russell 2000, the worst, being near a 3-year low. And now we look forward to what next week brings us. Let's go to some charts now. We'll start off. These are 18 earnings winners on day one anyway, but this will give you an overall tenor of how much risk the market wants to take on. This is one that's actually holding up pretty well, just going sideways while the market's pulling back since the earnings gap up on Netflix. Raytheon, 4 days up since its earnings report, when it reported that they've got to keep manufacturing the hell out of missiles that Israel's Iron Dome uses. So this got an initial bump up. Terrible chart before that Hamas attack, but it gapped up, went sideways, another gap up, and now 4 days up on big volume. We're taking a serious look at this, despite the fact that it's under the 200-day moving average. Spotify, gap up, 3 days down. GE, gap up, 3 days down. Well, not a gap, but a strong move and a high of the day close. Just enough to give people hope, right? Same thing with MedPace. Move up, gap up, move up, 3 days down. Terrible action. Gap outside negative reversal today. Money has been holed up in these retail apparel companies as the consumer spending continues to stay strong. You can see the relative strength there, but we're not rushing to buy anything with the market wins against us. Microsoft, gap up, 2 days lower. General Dynamics, gap up on its earnings, now down the last 2 days. VRT initially opened 11% higher. Big negative reversal right out of the chute. Second day lower low, inside day today. This, I think you are picking up what I'm putting down here with the gap up and then no follow through. And that's why this is not the environment to chase gaps or breakouts. Boeing had a decent move up on earnings, but not by the end of the day. And now two inside days since then. Waste Management, nice day up, pulled back the next 2 days. ServiceNow gapped up, closed at the lows of the day, hanging near the lows of the day. Mobileye, gap up, broke the lows of the day. Amazon, we'll see what next week brings. Closed mid-range on its gap up, which is still inside the base and couldn't get above the declining 21-day moving average, despite I read nothing but stellar reviews of its earnings report. Intel, gap up, closed mid-range. And Decker's Outdoor, this is one that stayed near the top and held its breakout. So certainly it goes on the leaders to track list. We'll see what next week brings with this, but I'm not betting on a positive outcome. And that's it. So as always, like to hear from you. You can email me, don@revereasset.com, or leave a comment on the YouTube page. We appreciate everybody that's been clicking like. We're getting about 30% of viewers clicking like. That helps the algorithms and it gets our work into other people's feeds so they can discover us and see that you don't have to be a slave to the market. You can actively, with common sense, take an approach to get the heck out of the way when the market is risky. You can also email my partner, Dan Stewart, dan@revereasset.com if you're interested in becoming a client, or the phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much of that you can keep. Our goal number one is protect the downside, and then the gains take care of themselves when the market turns healthy. And if you'd like more information on this approach, reach out to us. And with that, I will wrap up the video for the week ending Friday, October 27th. This is Don Vandenbord with Revere Asset Management, telling it like it is. Have a great weekend, and thanks for listening.